Hi, Warriors. How's everyone doing today? Shahab, Alexander, Glenn Jeffries, how are you? Sinatra, Mike Weissman. So, Mike, let me ask you a question. So, you didn't know about this place until I invited you for an interview, right? So, I'm curious why why you come here, why you show up, what you get out of it. And good morning, team.
Morning, Dale.
Morning, Dale.
Hey guys. So F.A.C.E is a place where pros come to do some intelligence gathering. What do you think? It's been, a lot of people I've interviewed, come as attendees. So must be some decent stuff we talk about here. Looking at cable, starting to lose a little mo. What are you thinking here, Ryan? Like,
Well,
the euro's not where I want to sell it. Never really got up there.
Yeah.
But, doesn't it look like if cable is setting up a correction that, we need to turn soon, or, we're just going to blow through over these highs? 100 higher than where we are now.
Yeah, I think a blow through is more likely than a decent pullback. He hasn't pulled back for the last 6 months.
Okay. All right. I'm taking a stab at it here. Risking the highs. I know there's a lot going on, and the expectation is a pause and leave the door open to go in July. Isn't that the Fed? What most expectations are. Do you remember reading about that? Paul said he didn't want to stop until he was sure. Okay, now look, right?
Yeah.
They didn't want to repeat the stop and start tightening cycles of the 70s. He wasn't going to make that mistake.
Well,
God, I tell you, huh?
We got stop and starts now, haven't we? RBA, BOC.
Yeah.
Yeah,
but I don't remember them saying that. I do remember Paul saying, off the 70s example here in the US where we started a tightening cycle, then stopped, and it was premature, and I think we had to do it 3 or 4 times. So I would consider this a stop start policy that he's beginning, possibly.
Well, that's half my thinking, and we spoke about it on the flow show. We've seen the RBNZ say they're going to pause and keep hiking, the RBA pause and hike, the BOC pause and hike, and I wonder if the Fed doesn't want to get caught in that. They'd rather get rates where they be happy and then do a proper pause. So I'm in 2 minds whether they pause and indicate another hike, or whether they just hike and get to where they want to go.
Yeah, well, I'll tell you, it's an important week for rates, for sure. Oh, here's a 10-year. So, it's a descending triangle. This 360 was important, right? Look at 360 all the way here. Then we had the pullback that held at 360 last week, and we started to bounce up towards the highs. I think next time through 360, we'll see 330, and if we take out 330, just a move of equality takes it under 3. So, that's, I think, the big setup. And then the other way is, break out over 390, we're going to new highs in yields. So, big week, it's not just looking at cattle doing this, or cotton, or the euro. This is 10-year yield. So really an important, what would you say, gas pedal or brake for the economy. So you have to pay attention to what happens here this week. I think we're going to resolve it one way or the other. And maybe we start tomorrow before the Fed with good inflation numbers.
Definitely. Tomorrow is more important than the FOMC. I've been saying that for a couple of weeks now. It's
okay.
because the market's leaning for a pause now, as you say. We get hot CPI numbers. We're going to be pricing a hike over the next few hours after the CPI report. It's going to be a big, big volatile move.
Okay. Silver had a good week, you know, so far rejected from 24.5, but not rejected much. Looks like it wants to go for it again. What do you think? What do we do with the yen? I'll go to Kman on this. This is the formation that I see.
Yeah, we're watching that. It's gonna be important more on the dollar side for this one than the yen side, I reckon. If Mr. Ueda is faithful to his communications that he gave us so far, we shouldn't see anything at the end of the week. But as I said also on the flow show, we cannot completely rule out that they come out with some kind of wording saying that they are looking at things to prepare us for the rest of the year. Because my base case is still that they will normalize in some form, but it's all going to depend on how fast and how much. But yeah, I remain pretty constructive, and let's say my bias is still for being a bit short yen, because they are going to be the slowest ones normalizing. But we cannot rule out what I mean. We cannot jump too fast in it. We first have to look at what CPI in the States will be tomorrow. And as I've been saying as well last week on the shows, I think the CPI tomorrow should be, or maybe more important than what the FOMC really does on Wednesday.
Yeah, you and Ryan in this camp. Steve, I'm glad you're here. I wanted to ask you something Friday. You know more about Elliott when Greg is not here than anyone else. Could this be a wave 4 triangle that would imply one more thrust that's terminal?
Yes, of course. I mean, triangles are extremely frequently terminal consolidations in a trend, right?
Yeah. Okay. So maybe we do get one more thrust. And what are your expectations for the Fed? What do you think they're going to do?
I don't really have any expectations. The chances are, from what I understand, is that they might pause, but at the same time send a message that people should not read too much into it, should not believe that the pause is the beginning of the next easing cycle, right?
Yeah.
Personally, I'm very skeptical, and as I've said 100 times, I consider it less important to understand what the terminal rate is going to be, and more important to see how long we can stay
up here.
Yes, up here before something changes.
Yeah, which would probably have to be maybe a break in the stock market if that ever happens. You know, it's a critical week, and besides market reasons for it being critical, it's also critical because happy birthday to you, Steve. Happy birthday to you. Happy birthday, Steve, the hardest working guy in FX. Happy birthday to you, Steve Volgate.
Happy birthday, Steve.
Happy birthday, Steve.
Thank you, guys.
What is it? 61?
Again,
How old are you now?
63. And next year it's going to be 73.
Yeah. Yeah, don't laugh. 63 sounds okay. So anyway, Blake, good morning. What's happening? Don't suspend me. I didn't watch the week ahead video. What was
what? Wait,
the message?
What?
Yeah,
why are we keeping this guy
I'll go
here?
stand in the corner or something, but I didn't do it. So, but I want to know. I'm just a lazy guy, you know.
I mean, seriously, what you can't watch the video and then you come over here and ask for a shortcut, like a
Cliff Notes.
some cliff notes here on the week ahead video. Geez.
Yeah.
You know, I set my mom aside to make that video for you. I hope you understand that, right?
All right. Well, I'll never do it again.
You know, I mean, I think we're all just waiting for, you know, obviously this is a big week with the Fed, the BOJ, the ECB. You know, I was listening to Ryan's comments a little bit earlier. Ryan, welcome back, by the way.
Thanks, mate.
So now you got to tell us really quick, us Americans that only watch soccer, what happened over the last week with West Ham, your team?
Well, the short version is went to Prague, got pissed, won a trophy, came home.
All right, there you go. That's a good time. Well,
I'm European and I don't even know what that trophy is. I have to tell you.
What a trophy is?
I have no idea what kind of a trophy that is.
What tournament did you guys win?
The Europa Conference League. It's like the third tournament. You get the Champions League is the main one, the Europa League, and then the Europa Conference League. But we don't care. We haven't won anything for 40 years. You could give us an egg cup. I'll be happy.
So, and I'm not messing. I'm not messing with you. I'm not joking about it. Who exactly participates in that? I know who participates in Champions League. I know who participates in Europa League, but I have no idea who participates in that one.
Champions League, which I won, by the way.
Yeah, loads of teams, Steve. Loads of teams participate in it. We beat Fiorentina, and Electra in it. Yeah, lots of big teams are in it.
Okay, I guess congratulations are in place.
And there's the trophy.
Okay, forget I asked. I just wanted a quick answer, but that's awesome. Just kidding, guys. So what does that do for FX, and what does that do for the markets now that West Ham's taken this?
I guess that should be good enough for at least 10% higher in the pound.
It must be, or you know, I think the risk rally should be a little bit further than where it is currently. But Dale, you asked like, you know, what's up with the week ahead video, or what did I talk about? I was really talking about what are the best, what I feel are the best setups for, you know, dollar weakness and dollar strength. And you know, I think there's certain currencies that are really set up well, but one of the big focal points is going to be the dollar yen. And, you know, we're in this nice little triangle pattern developed, you know, above 138, which is a key level of support.
Right.
And we're just consolidating, ready for, you know, either move to 142.50 or back below the 200-day moving average, you know, at 138. So, the breakout point's 138. The 200-day moving average is, you can see it's moving flat at 137 and change.
Yeah.
But I think that, you know, we're going to figure out, you know, shortly after the FOMC, whether we're doing this or we're doing that.
Just like
and I think the dollar yen's really set up for a move here.
Yeah, just like the 10-year. It's a very similar setup, good or bad, from, you know, pretty close to where we are.
Yeah, and you know, and I was, you know, I wanted to again go back to Ryan's comments about the Fed, and I think that's a lot of people are really looking at this Fed meeting, and they assume the Fed is going to just, you know, they're going to pause like everybody else, but could they really just want to, you know, ramp up rates to where they think is, you know, they need to be? And I think that's an interesting concept. And but if they do that, it would be a dovish hike, right? I mean, that's the way the market would that's how the market would end up reconciling it. And why I don't think if the Fed did that, it would be necessarily bearish for the stock market. I think
it's really funny because the market thinks that we're either going to have a hawkish hold or a dovish hike.
Well, the market's going to convince itself that it's bullish either way. So, you know, you have to imagine that.
I agree with you, Blake.
Yeah, sentiment is so bullish right now on the break above 4,200. You got everybody repositioning themselves, getting bulled up now, and using anything that's going to happen to fit their bullish thesis. Now, I don't necessarily think that that earnings are going to be getting any better going into the second half of the year.
On the cover, the bull is back.
What's that?
Barron's had on their cover, the bull market is back. There's one major periodical. And you know, I'm seeing a lot of tweets people, hassling bears and talking melt up, using the word melt up, like Dave H. Contrarian does. So you're right. A lot of people bulled up.
Also,
He's
Goldman
been
Sachs. Goldman Sachs have
hasn't
a.
he?
Sorry.
Sorry, Stel. He's been a bull though. That contrarian dude, right?
Yeah,
Yes.
all the way
Yeah.
through, even when it was pulling back to 3,800.
Right.
3,400. Yeah. So
well,
now it looks good.
You're going to be in a range bound market. You'll be right at least half the time, right? So
yeah.
Goldman Sachs also have a target 4,500 for the S&P now, so that should scare us a little bit.
Damn squid, that's great. All right, well, we are at the 618 retracement on the S&P. It does feel very like squeezy, and it feels like we could at least make it to 4,400 pretty easily. As for a technical target while we're above 142. And if you're inside the ForexAnalytix community, you listen to the Morning Edge every day. As I've said every day last week, okay, as long as we're above 4160, there's zero reason to be bearish. There isn't. We got bull flags that are developing. Now we are at resistance, so we'll see if this 4320 level will hold. I mean, but the whole world knows about this level. It's not like a secret magician, like sauce that you got to. It's everybody knows it's horizontal resistance and it's a big fib level. But we break above that, and FOMO and FOMU is just going to kick into higher gear, and so we're going to get a move up to 4,400. And then you have to think about, what does that do to the positions that you're holding? Where does that take everything? So
I would say,
think,
Blake, on this blow off, people that own shares that are not making new highs, along with this melt up, be suspect of them. Okay, that's all I could say.
Yeah, and there's going to be a lot of those. I mean, if you look at the weighted S&P, I mean, this is telling you specifically, there's a lot of stocks that are not participating right now.
Yeah,
this is the S&P equally weighted, so you can look at that and go, well, crap. There's probably only a few that are making their way higher, and that's where the NASDAQ 100. I mean, we're right up against our highs here. So anyway, and speaking of which, if the NASDAQ 100 breaks its 127% extension, probably a good chance that we can start seeing some of this resistance up here, because that's not too terribly far away. So Stelios, you're going to say something a little earlier, and I think I stepped in front of you. So what's going on, Stel? What do you think?
I was just going to say, regarding equities, we have been saying, you, me, Steve, we've been saying, everybody on this side basically have been saying that there's really no reason to be short equities as they just kept grinding higher. And we've been saying it for weeks. They do not look, the S&P does not look bearish in any way. Slowly now, we're starting to get signs that this move has probably one final thrust. Now, I think that and I don't want to make a joke out of them, but the Barron's cover is a perfect example. Whenever they show something, it's usually the top or a bottom of something, and then you have big banks like Goldman Sachs saying, "Yeah, we're going higher." It's soon not going to be the pain trade anymore. That's what I'm worried about. So more and more people get bulled up. If we do break above 43.20, which is those highs, 20.25, I can't remember the level exactly, then you're going to get a lot of FOMO. People are going to get in, and then the pain trade is going to be long. So for now, it's definitely not worth being short yet, but I think the time is coming. And this final thrust higher, will it be brought by a weak CPI? I think most likely. And then we get towards 4,400, and then I think things could really change. But for the moment, nothing for me to tell me that we should be shorting this market. Not yet.
Yeah, I don't think there is anything at this point in time either. So during the flow show, what did you guys really hit on today? Ryan, Kman, what did you guys, and Stelios, what did you guys really talk about today that's front and center that us as North Americans, we're just waking up, that we should be thinking about?
Oh, there's tons, isn't there? I mean, we covered the CPI, but it's also important to know there's the first June data out from the US. We've got the Empire and Philly Fed on Thursday, so it's going to be the first bit of data for the new month straight after the FOMC. So whatever happens to the FOMC, however they leave it, the market's going to already start trading the July FOMC via data such as those.
Okay, and which one, as far as like some of the setups, what are you thinking here? I mean, because I look at the sterling and we just knocked our head up against the underside of this, broken trend line, previous channel, 78% retracement. It looks like we're stalling at 126, basically. That's the top of our resistance zone. The euro still bear flagging it. We're below the 38% retracement. We can't even complete an equal leg move. And I've been trying to get short above 108 all of the end of last week. It's been, thing can't make a new high. Is there any standout technical levels that you guys are looking at over there?
Euro sterling down in the 85s, because obviously you got the Bank of England next week. So we get over the ECB hump. If there's anything hawkish out of those guys, this has been sold off on the possibility of a more hawkish BOE. So if you get a rally in this one, it might be something to look at up to 86 and a half to run into the Bank of England.
Do you think you're a buyer down here at this 85 and 85 and a half pence?
I'm looking to be a buyer at 85, at least on the techs, depending where we are going into the Bank of England. I think if we get down there, that's pretty much the BOE priced. But I'll be happy to nick a short if we see a euro rally on Thursday.
Okay, all right, Kman. What have you been thinking as you've had some some time to take in what's happening on a Monday and over the weekend? What are your thoughts going into this week?
My main thought is still that I think it's Lagarde's last hawkish meeting coming up. So I'm looking at even though the market still expects some more rate hikes, there's interest rates, and then there's what's happening in the market, which is data in Europe starting to come down a bit. To me, it's going to be Lagarde's last hawkish meeting on Thursday, and I'll be closely monitoring it. I don't have any euro positions right now, but I'm keeping my eyes peeled, and actually slightly lower US CPI tomorrow without really falling out of bed, maybe setting us up for some decent levels to, for me at least, to look at some euro pairs, not necessarily euro dollar, because I still think it's a tool to do anything else. But some of those euro crosses, perhaps lean into them again. That's what I'm
so as far as the CPI, what are you going to be your thoughts on the data that you think is coming our way? From the CPI data, like the core, the headline number.
Yeah.
What do you think?
There's people thinking we dive under 4% in the headline CPI this week, and which would be a biggie, coming down already expected from 4.9 down to 4.1. That would be a biggie, despite what, of course, the Fed is watching the core, and we know all of that. But it would be something if the headline comes down below 4%. So that should weigh really on the dollar, send stocks higher, and probably see dollar yen trade lower, and then but yen crosses could be doing relatively well on the back of it. So those are the kind of things that I'm looking at. If it's stubborn though, then I'm going to look at probably buy dollar yen again, and I think then we're going to go back above 140, and why not much higher again.
Okay, well, the charts are really I mean, we got this nice triangle that's been developed in the dollar yen, so it could very easily cruise back above 140, and especially if that inflation data, if it maybe bucks the trend and goes a little higher. What if a lot of people think that this inflation data is not just US inflation data, but globally it's going to continue to kind of drift lower, and we're going to continue to trend lower. What if it doesn't here in the US? There's certain pockets around the globe that are still showing some some stickiness for inflation. You know, and by the way, I just anecdotal evidence here, total anecdotal evidence. I actually have talked to multiple real estate people over the weekend. Homes in my area. Now there's some reasoning for this, just so you all know. Where I live in the desert, the current governor says there's going to be no more building projects, you know, because we're going to run out of water in 100 years if we do. So basically we're not building anymore, kind of like turning into like New York, if you will, but out here in the desert. There's like real estate people are like just going crazy. There's people like bidding over, you know, ask for homes, which is a little weird. But I hear that, you know, and I was just talking to other real estate agents regarding this, and Arizona may be a little bit more of a phenomenon, but we're in a kind of a crunch here, and the Fed put themselves in a situation when you have like, you know, rates up at these levels, because now you have a housing issue, and it's now going to translate into an inflation issue, because you got so many homeowners that don't want to sell their homes here in the US, and the dwellings is a big part of CPI, guys. You know, you got so many people that don't want to sell their houses. They can't move because their interest rates are so low, yet inventory is so low. So it's keeping housing costs really, really high here in the US. Like I said, here is a little different than everywhere else, but it is an issue with what the Fed's kind of put themselves in this box. So when I look at CPI and I look at inflation, and people expect inflation to really come down, you know, that's one part of it it's going to be very difficult. So I think the Fed's going to have a little bit of an issue moving forward regarding inflation. So, you know, yeah, CPI may continue to trend down a little bit, but are they going to be able to reach their goals? I don't know.
Well, he picked two targets in the economy where there are secular shortages, employment with baby boomers retiring, and a worker shortage. And before this, we've had a housing stock shortage in this country for years now. So he's attacking things that there are supply issues with.
Yeah.
And then
go ahead. No, I said then you're continuing to create your own problems by having rates at these levels for extended periods of time. But anyway, go ahead, Stel.
I would argue, though, that the nature of housing has changed a lot over the past 10, 20 years, in that there's a lot more properties owned by corporations, and, you know, people have been for the past 10, 15 years taking advantage of really low rates to take, you know, second, third, fourth homes and rent them out, you know, Airbnb, all that kind of crap. And so I think that what you described in terms of people not wanting to sell their own homes because they live there, I think that kind of scenario is a lot less important than it was 20 years ago. So I think the market's now a lot more sensitive to interest rates, house prices. Obviously, constraints like the one you said about your area, I mean, that's a special case. But I think overall, these high rates are going to be an issue, and they don't take effect straight away. You see this gradually as people refinance, how people struggle to get mortgages to buy because they're quite expensive now. So I think you see a lag 6 to 12 months after rates go high, and you start to see it in housing. I still think housing will correct a little bit, but in the long run, everything's going to go up because of inflation, because of the way deficits are run by all major governments, and that's the end of that, you know. So when you're buying a house, you try to find the dip, buy the dip in everything, basically.
Yeah, there you go. And maybe we should be buying this dip in gold, because we're getting a little bit of a dip of gold and silver right now. But I do want to point out the dollar CAD is near some really key support. If you guys missed the conversation I had with Mark Chandler, he really, I thought it was a really great conversation, because he was talking about the fires that are in Canada right now and how it's going to affect Canadian GDP going into the second half of the year. And so this could be setting up to be a good range trade where the dollar CAD could be a nice long down here. It's a real good interview that I had with him at the end of the week, this last week. especially for those of you that have Canadian exposure. Real quick, I know, we don't have data, but I know you got Pedro da Costa. He's going to be here. One of my favorite, journalists out there. So you guys are in for a real treat today with Dale. But I just want to say, dollar Canadian's near really key support. You've got the euro that's really struggling to even get above the 38% retracement. This is a nice bear flag pattern that's developing. Dollar yen's consolidating. And tomorrow is going to be a big day as we're going to do CPI live on the show. So, team, I want to thank you all for being here. Is Pedro here, Dale?
Yes, he is. And,
Okay,
I was going to say, team.
Yep. Go ahead.
If you have a question for Pedro, stick around and feel free to interject and ask him. Right, Pedro? Hi, buddy.
All right, I'm gonna pass it over to
Hi
you
there.
guys.
Sorry about that. I was muted. Yes.
Yeah.
Stick around. I'm here.
Stick around. There's a lot to to really cover, a lot of ground.
Absolutely.
Awesome. Well, have a great interview, Pedro. Welcome to the Face and welcome back. And Dale, it's all yours.
All righty. Okay, Pedro. So, I gave you a question to ask Jay Powell last time. If he thought monetary policy was too loose because of what people are paying for concert tickets.
That's right. I forgot about that.
Yeah. And, so anyway, what's top of mind going into the next couple of days with CPI followed by the Fed?
Well, one of the things that's top of mind is just how much discord there's. I think this is like one of the periods where we've seen the most internal disagreement within the Fed that we've seen since the start of the rate hikes.
Okay.
I think Jay Powell has been good about building consensus so far. And in part, that was because once the realization set in throughout the Fed system that they were behind the curve, it was easy to get people on board to catch up, and getting people to align behind 50 or 75 wasn't particularly difficult. But now that we're getting to a point where there's actual, I feel like there's true discord within the system as to whether they should keep going or whether they should wait and see. And that depends in part on what your view is on long and variable lags and how much credit tightening we might get. And so, I'm not saying there's going to be a dissent at this particular meeting, but we're getting closer to the point where people are actually actively disagreeing within the system. And that's going to make for some exciting times, I guess. Okay. And the CPI, having the CPI on the day of the meeting just adds to that mix, right? They kind of in another kind of communications, maybe not a blunder, but it's not particularly clear when you commit to a pause and you say you're data dependent, but you're not waiting for the data to actually speak for itself, and then the data has kind of gone in the other direction. I mean, it's been mixed enough that they could argue for a pause, but it's hard to say jobs, wasn't strong and the PCE wasn't strong. And so if CPI does come in strong, it's going to, again, lead to market doubts about what the Fed is likely to do. Although I think the preponderance is for them to pause and then move again in July. But I don't think
hike.
Yeah, skip and hike.
Which is exactly what Paul at the beginning of his campaign said he did not want to make the mistakes of the 70s and repeat them.
Absolutely. The start-stop monetary policy. Yeah, exactly.
Right. So we're on the cusp of something else Jay Powell said that he's, not going to follow through on.
And if you look at the behavior of other major central banks, they've had to do the exact same thing, right? The Bank of the RBA, the Bank of Canada, they've all had to resume hikes after a pause because inflation is sticky. And that's another reason to kind of believe the hawks when they say and think that inflation is not just going to go away in the second half of the year. Is, the trend seems to be fairly global, just regardless of the internal dynamics of particular economies. And it's all very labor driven as well. This sort of post-COVID tightness in the labor market that's befuddling everyone. We have labor shortages from Italy to Canada to the United States. So
do you think our banking problems are over? Everyone's acting like it is.
I definitely don't. I think it's kind of a slow burning problem, and the Fed threw massive amounts of money and liquidity at it, and so it's kind of like it's hard to say that it wasn't just a palliative and that it's really actually over, because the banks still have those enormous underwater treasury positions. They're just simply able to not kind of mark them to market at the moment. And so I don't think we're out of the woods on that front. I also don't think that we know what other financial instability issues might rear their heads later in the year. Because if you do believe in the lags, even if you think the lags are fairly short, chances are that you haven't felt the full impact of the hikes, considering we just hiked at the last meeting. And so there's still potential for other blowups in the financial system. And that's actually the main thing that I think could cause the Fed to pivot. When people, when markets price in, I mean, I know that they've priced out some of those cuts at the end of the year, but when markets price those in, a lot of it is based on the expectation that the Fed is going to flinch at the very first sign of economic weakness, meaning like the first spike you see in unemployment, the Fed's just going to cave and start turning around. But I think it's,
go
ahead.
The market acted that way after the claims last week.
That's right. That's right. Yeah. It's true. And so, but I think that it's actually going to take a financial event for the Fed to be more responsive and to actually consider reversing course.
Is there any truth that everyone's looking at the commercial banking system, but most of the credit is being supplied by the shadow banking system, that over 50% of credit and loans comes from there, and they're less regulated, I believe?
Yeah, they're less regulated and a lot more opaque. So they're like, regulators have a ton less visibility into what is actually happening there. The irony is that we came into this tightening cycle with everyone warning that the major financial risks were outside of the traditional banking system. But then then you get the first major blow up is right under the Fed's nose, like in the sector where they do have great visibility and should have been able to predict and potentially stop it, or at least kind of give more stern warnings. And they were remarkably kind of honest in that post SVB report about admitting to regulatory failures and the kind of general lackadaisical attitude toward regulation. But now, again, there's no reason to think that just because the problem started at the regional banks that they won't spread to other areas, whether it be money market funds or hedge funds. I mean, money market funds have benefited in the short term from this outflow from the commercial banks because they're just offering higher returns.
What kind of paper are they buying? Right?
That's the thing.
Risk?
Yeah, exactly. So they expose themselves to some of the similar risks.
And what about Europe? They actually the bonds they own, notes they own, whatever bonds they own, had negative rates. So don't they actually have to service a losing trade?
Yes,
it costs
absolutely.
them money to carry a losing trade that they won't mark to market, but they have to service it.
Absolutely.
So I'm wondering why we're not hearing about stress in the European banking system as much as we're hearing about it here.
That's a good point. It might be, the ECB started hiking later, right? So it could be part of those lagged effects that we were talking about. So
here's the regional bank chart, Pedro, and to me it looks incomplete. I know we've had a recovery here. That normally things come in threes, and we have two. I think there's another break there, and then you know what? The major money center banks don't look that much better. They took it on the chin. S&Ps are making new highs. Nasdaq's blown off, and this to me looks like a bearish consolidation. Sure, it could go to 34, but I don't think we're going to 37, and almost looks like it could break down again. So to me, it feels like we're whistling past the graveyard with a major banking crisis. Might even be similar to what we had in the 30s.
Yeah, I mean, certainly it might not be that different from 2008 in the sense that you see these small problems bubble up, and then everybody says everything's okay. And
wasn't that way? And like Lehman went bust, but everyone, the markets kept going, and everything was okay for a while.
Well, it was after Lehman, things kind of fell apart. But I would say, I would think of it as an earlier, like late 2007 episode where there were things like, WashU and no, I mean Washington Mutual rather, and and Countrywide, and names that we've almost forgotten in the trash bin of history. And and now and then they end up, they ended up being kind of the precursors to much larger blowups. And after Bear Stearns, there was a distinct sense that the worst was over, and everybody, positioned that way.
Oh, that's what I meant to say. Bear Stearns.
After Bear, yeah.
So
and then by the time Lehman came around, then it was another 6 months. Because Bear was in March of 2008. By the time Lehman came around, then you had Fannie Freddie kind of blowing up at the same time, and that's when it got really serious, and the job losses started to enter the hundreds of thousands. And again, we talk about this.
Took a long time, a lag.
We talk about this de facto guarantee of uninsured deposits that kind of emerged after SVB, just by the actions of the regulators. And it actually, if you look back, the thing that I remember putting a floor on the market in March 2009 was actually when the FDIC came out and guaranteed the bonds of the major financial institutions. And I kept joking that if I could issue, FDIC-backed Da Costa bonds, I would be instantly rich, right? Any of us.
Right.
But so once you have the backing of the taxpayer, you're pretty much golden. But one would hope that's not what it's going to take, but it's hard to see how we don't get there given the speed of the rate shock that we've had, right?
Yeah. And
so,
So the Fed has a lot to think about. And don't you think the Fed knew what these banks had on their books before he went on his tightening campaign? Didn't it that he knew there'd be problems with them?
They certainly should have. I mean, that we don't know how much, because it's not the kind of thing that they can admit publicly, but, maybe they hope for kind of small breakages that would be credit restraining, but nothing kind of as severe as what we might get. But yeah,
doesn't the Fed would see if, wanting to launch a CBDC would rather have, 5 buddy banks, the partners he already has, the Fed already has, and they really become the bank because the CBDC doesn't come from the Treasury, it comes from the Fed.
But I'm not actually sure that the Fed is that keen on the CBDC. I'm not so sure that the Fed is particularly keen on CBDCs. Certainly not as much as some other global central banks. They're like kind of lagging behind on that front. So I'm not sure. And I think that's in part because the financial, the large banks are also not particularly keen on it because they see it as
profits, cut through a lot of
exactly. And considering how much influence those banks have on the Fed system, both direct and indirect, and through their presence on the regional boards of the Feds, I don't know that they actually want that to happen, and that's why the Fed is not like a leading voice on CBDCs, whereas the ECB and China are a lot further ahead on that front. So, but if you recall, the day of the last press conference, Chair Powell said something like, he basically he described for the JP Morgan acquisition of First Republic in quite favorable terms, and kind of suggested that they'd put a line under the sand of the worst of the crisis. And then that night, like Pac West just tanked, and it appeared that things were not bad. So
and Janet Yellen's been talking a lot lately. She sees that there will be more consolidation in the banking industry, which isn't that really code for failures?
It kind of is at this point, right? It just means that it means acquisitions. It also means that they have to loosen their own kind of rules. They've been kind of against additional mergers and concentrations of deposits, but that stuff is only getting worse, which again raises the potential for future trouble down the line. One of the big issues the Fed's going to have on the macro front is that even if headline inflation starts to come down, which it looks like it's going to, given what's happening in energy,
Right.
core just looks stuck, right? It looks stuck at 4.5, the upper fours, and that's a real problem for the Fed, because the Fed does look at core inflation as a better predictor of future inflation than headline. And that's going to make a lot of the Fed uncomfortable. Now I would say there's like a minority within the committee that looks at the skip thing as kind of like a way to buy them time for inflation to fall enough for them to really just pause. They don't actually want to hike further, so they say skip, but they really want to pause. But I think that's a minority. I think the rest actually do think that there's going to be a need for further hikes.
Well, looking at the 10-year, Pedro, if we start closing over 390, yields are going to new highs. 360 has been a big level. If you look to the left, see 360, big pivot. We broke out, went to targets. Here we are at 360. This formation implies a decline in yields, especially if we break down. We could be under 3%. What do you think could cause that? Could it be risk off or another banking problem? What could drive it? Do you think the inflation numbers are enough to take yields from 370 like to 280?
I think yes. I think if there were the impression that the Fed has a lot more work to do, right?
These are yields dropping. If we drop,
I see what you're saying.
Yeah, 370 to 280. The only thing I could think of would be some type of risk-off event.
Yes, a risk-off event that does the opposite of what I just said, rather, that leads people to believe that the Fed is actually going to have to reverse course. Yes.
Okay.
But again, I would think that it would take a financial event for them to believe that, rather than just regular old economic weakness.
Okay. What are you looking forward to asking them?
Well, these days I don't go into the press conference. I send my colleagues in because they tend not to give me the mic. They tend not to give me the microphone, so I prefer not to waste the question.
All right. Okay.
But the questions are kind of pretty obvious. They're like, I think one of the big questions is, what are the long and variable lags? Because that tells you a lot about where they think they are in the cycle, and there's a huge discrepancy within the Fed system as to whether you think that the transmission mechanism has gotten faster because of kind of greater transparency and communication, which means that you've already kind of absorbed the bulk of the hikes and you might need more because they haven't had their effect, or whether the bulk of tightening is still potentially to come, in which case, like, the pause scenario you can make more of a case for it. Okay. Another thing is just kind of narrowing down their reaction function. I think there's a lack of understanding in the markets. That's the reason for it is that the Fed itself isn't very clear about this messaging. Like, what are they actually reacting to? Data dependence is like, you think you take the collection of data within the past 6 weeks or whatever the intermeeting period is, and you make an assessment based on that totality. But when one data point appears, to have the ability to swing their decision, it almost seems like data reactivity.
It's conflicting data.
Yeah, and so that leaves that makes it very hard to figure out what the next move is going to be. Another big item, of course, we get the SEP this meeting, and I think one of the things that they're likely to do if they pause is they're going to try to raise the median dot on their forecast for where the terminal rate is, to kind of show the market that that we've stopped but we're not done yet. That would be the kind of messaging that I would expect.
What did they do? They just put white out on the other dots and then color in another one, Pedro? How does that work?
They just draw a rainbow around the top.
Pot of gold.
Exactly. Well, no, I think it works. They claim that it's all like individual policymakers not talking to each other and in a vacuum, and then you just end up with a median. But it's kind of clear that the chair kind of he doesn't massage the dots himself, but I'm sure in his calls with in his sort of pre-meeting calls with all the regional bank presidents and his fellow board governors, they kind of discuss where their dots are going to be, and there's some kind of pre-gaming as to where they expect the median to end up. And so So they would do that by lifting the median from its current like 5.1 level to 5.4 or something a little bit higher to reflect a little bit more hiking, at least another 25 basis points.
Do you have a dollar view or what you're looking for movements? I know we have the BOJ later in the week, but just a dollar. I still feel that the market is still overly bearish a dollar. This rally wasn't embraced. Most even bulls said, it'd be a big deal for us to get back to 105. Euro has really had a hard time recovering off this initial decline from 110.5. Do you have any views on?
I really don't, to be honest. I really don't.
I don't blame you.
I don't pay enough attention to to the everyday movements to have a good opinion.
Okay, because the dollar is kind of the fulcrum where everything revolves. So just talking about the Fed and wrapping it, what do you expect from the presser afterwards? Do you think that Powell's going to be able to, satisfy people, or is it going to be, another cloudy message?
I think it's going to be cloudy. I think one of the issues with what we've seen in the last 6 months from his chairmanship is a lot of confusion as to what he's actually paying attention to. Seems like he brings up different things at different times and then they kind of fade away. At one point, JOLTS was the big thing to watch, right? But if you were going by that, then the recent rebound in JOLTS would be a case for continued hawkishness. Yeah. And he focused on ECI at one point, and wage growth is still fairly robust, but that kind of faded away. And then we changed to super core. So I think he's, and they've said there's not much movement in super core, which again would suggest that they should be hiking. One of the interesting things is one of the contradictions right now is that if you recall, right before the SVB debacle, Powell was actually hinting at a 50 basis point rate hike, and the market was pricing in a 6% terminal rate. Now, the question is, though, you and I may agree that these banking problems are not over, but the Fed seems to play them down and the market is playing them down as well. So the idea, my question is, if that credit tightening is not actually going to take place because of this regional bank turmoil, then shouldn't we reprice the terminal rate back to where it was before it? And so I think
that
he's
would
gonna
be the surprise if he went ahead with at least 25 basis point hike. Would you think that would surprise the market?
That would be a huge surprise. I mean, I think even the market is so keen on having him pivot in some way and has been for so many months that any hint of hawkishness, I think, will be really negative for risk.
Okay.
And so, yeah, that's my general sense. But I think he's gonna walk a fine line, and he's not gonna say they're done, right? As some in the market would desire. And he's not even gonna say that like we're just gonna do one more and then we're done, because I think it's too open-ended and there's too much uncertainty around it.
Yes, great discussion once again, Pedro. Thank you so much for giving us some things to think about before we click our mouse over the next couple days. And best way for people to follow you, Pedro, Twitter and MNI. Go ahead.
Absolutely. I'm on Twitter at PDacosta, PDACOSTA, and you can check out the website at marketnews.com. Check out the story that I have pinned to my Twitter account. It's gotten a lot of interest. We reported that the Fed is actually considering a shift away from the 2% target, potentially toward a target band, as some other countries have undertaken. The idea being that they're kind of they're embarrassed that they were so such sticklers for like undershooting the inflation target by like 1/10 of a percentage point, and now they're trying to be more realistic. And I think a range might be a more realistic approach to inflation targeting, but it also leads to accusations that they're moving the goalposts and that they're raising their inflation target because they can't achieve it. So
they're not getting their credibility back. You know what's a great thing about a band, Pedro?
What's that?
They stretch.
Exactly.
Right, a target
Well,
is a target, but a band,
yeah,
lots of
yeah.
flexibility with stretching. Let's just say he now has a rubber band monetary policy.
That's a good, perfect analogy.
You can use it.
I will.
Thank you so much, buddy.
Thank you
Really,
so much. Thanks for having me, Dale.
yeah, great catching up with you, Pedro.
You
Pedro
too.
DaCosta, everybody. Follow him at P DaCosta on Twitter and go to M&I and read their stuff, and it's going to edify you.
And
Karen,
check out my
yes.
podcast. It's called Fed Speak, and it's available wherever you get your podcasts.
Yeah,
So,
is what, Spotify and all those other.
Spotify, Google, and Apple mostly. Yeah.
Okay, Pedro.
Thank
Keep
you
up
so
the
much.
great work, man. You're a watchman for us.
Thank you very much.
All right, Pedro. So that's a wrap, everyone. You could join the team in 20 minutes on the Morning Edge. Don't just count your pips, count your blessings. See everyone tomorrow. Adios. Thanks again, buddy.
Thank you. Take care.
Adios, bro.